season coming up for earnings in terms of what they report, in terms of guidance, and in terms of what the stock market reaction has been. So it's probably a good week to watch CNBC, but you might not see things that make you real happy.
Well, Joe, we knew that this was going to be a tough quarter. The Fed has raised rates, and it's having an effect on the market. It's having an effect on housing prices. It's having an effect on employment and the way the companies are viewing their future year plus. So we have to be watching very carefully who is able to maintain guidance. What's going to happen this quarter with sales growth? We've already seen it on the retail side. But there are types of companies that will be able to persevere through this, and we're going to be able to separate by listening and asking questions some of the strengths in the business world and where there are weaknesses. I mean, we know at parity that the dollar is going to be hurting because it's so strong on multinational companies. We know that certain sectors like retail have already talked about what's going on with the consumer and how the consumer is spending. And so this is what consumers are nervous about. Plus, when you shut down casinos in Macau, we worry about China and another possible lockdown because of a COVID variant. So, of course, this is going to be challenging. But we're down 20% already, roughly, on the S&P this year. It's not as if investors have not noticed that there was trouble coming. Investors are well aware that there are going to be weakness, which is why we've taken the market to this level. And if we can hold around this 3,800 as support, I think that would be a reassuring sign. It's not as if there are no positives to consider. There are some, but as I mentioned, and you quoted so nicely, definitely challenges this quarter.
So you think that in the last month we've seen signs that the economy has slowed. And what about the jobs number? That's the rearview mirror?
You know, it's very interesting because the unemployment rate has held in at around 3.6%, very low for a recession. I mean, lower than one would expect. One of the things that we have looked into is the whole idea that there was some over hiring in places, that we, in fact, began to think about employees and hiring a bit the way companies just really had to overorder and develop large inventories. Not that people can be compared to inventories, of course, but during COVID, we really didn't have a sense for what was coming. And so there was a scramble to get employees. There are many people who have taken jobs, moved to different locations. There's been an entire disruption of employment. So that 3.6%, I think, is a little bit of a challenging number to think about realistically. It may be that some of that is fragile. Some of that employment on the margin is fragile, and we'll start to see those numbers go up on the unemployment scale over the next couple of quarters.